Introduction. Good morning, afternoon, everyone. Today, I'll be discussing the small loan industry in Canada, with a specific focus on our local context here in the Waterloo region. This industry, often part of what's called alternative financial services, primarily serves individuals who might have difficulty accessing traditional banking products. We'll look at the types of loans offered, who uses them, the regulations involved, and the broader impacts. What are small loans? The industry mainly offers two types of products. One, payday loans. These are short-term loans, typically for small amounts, usually $1,500 or less meant to be repaid by your next payday, often within 2 weeks. They are known for quick approval, often without a credit check. However, they come at a very high cost. In Ontario, as of January 1st, 2025, the maximum charge is capped at $14 for every $100 borrowed. While this sounds like a fee, it translates to an extremely high annual percentage rate, or APR around 365% for a typical 2-week loan. 2-point installment loans. These are offered by some of the same lenders but involve larger amounts, potentially up to $25,000, repaid over longer terms, like months, or even years, through regular payments. While their APRs are lower than payday loans, they are still high, often approaching the new federal criminal interest rate cap of 35%. Who uses these loans? The users of these loans are diverse. While many have low to moderate incomes, a significant portion have moderate or even higher incomes. They are typically working-age adults, though use among seniors is reportedly growing. Key characteristics often include experiencing financial stress or facing unexpected expenses, having limited access to or perhaps negative experiences with traditional credit, like bank loans or credit cards. A concerning trend is repeat borrowing. Many users take out multiple loans per year, sometimes getting trapped in a cycle of debt. Certain groups appear overrepresented, including younger adults, recent immigrants, Indigenous peoples, and single-parent households. Here in the Waterloo region, our demographics with significant working age, immigrant, and student populations, along with documented housing affordability challenges, suggest a potentially strong demand for these types of services. Why use them? The pros and cons. So why do people turn to these loans despite the high costs? The pros from the user's perspective. The main drivers are speed and accessibility. Funds can be obtained very quickly, often within hours, especially online. Qualification is easier than at banks, often bypassing credit checks, making them available to those with poor or no credit history. They can seem like the only option for covering urgent, essential expenses like rent, utilities, or emergency repairs. The cons. The drawbacks are significant. The cost is extremely high compared to almost any alternative. There's a major risk of falling into a debt cycle due to the high costs and short repayment terms. Defaulting leads to more fees and can severely damage credit scores, while timely repayment usually doesn't help build credit. This can cause significant financial stress. The regulatory landscape. Regulation is complex, involving both federal and provincial governments. Federal level historically, the criminal code capped interest rates at a very high level, effectively around 48% APR, but payday loans were often exempted if provinces regulated them. Recently, the federal government made major changes. The general criminal interest rate cap was lowered significantly to 35% APR. A national limit for payday loans was proposed at $14 per $100 borrowed in regulated provinces. Provincial level Ontario. Example, Ontario has its own Payday Loans Act. Key protections include the $14 per 100 cost cap. A ban on rollover loans, extending the same loan with more fees. Mandatory extended payment plans for frequent borrowers. Strict licensing requirements for lenders. Municipal level cities like Kitchener can also impose local rules on where storefronts can operate. Industry trends and challenges. The industry is facing several key dynamics. Shift to online. More and more loans are being accessed online, offering convenience but also raising concerns about unlicensed lenders. Operating outside regulations. Impact of regulations. The new lower rate caps are putting significant financial pressure on lenders. This could lead to market consolidation, fewer lenders, some potentially closing, and a strategic shift towards offering more installment loans instead of traditional payday loans. Public perception. The industry consistently battles a negative public image, frequently labeled as predatory due to high costs, and perceived targeting of vulnerable individuals. Economic and social impacts. Beyond individual borrowers, the industry has broader effects. Household debt and insolvency. While a small part of total debt, payday loan use is strongly linked to consumer insolvency. A high percentage of people filing for insolvency have payday loans, often multiple ones. Financial vulnerability. Using these loans is correlated with financial instability. Things like being behind on bills or lacking emergency savings. The loans themselves can worsen this vulnerability. Climate change impacts like extreme weather are even emerging as a factor, increasing demand and defaults among vulnerable users. Community wealth drain. High fees and interest paid often flow out of local communities, particularly lower income ones, to company headquarters elsewhere. This wealth drain reduces local spending power and can exacerbate economic disparities. This is a relevant concern for areas within the Waterloo region facing affordability challenges, ethical concerns, and the rate cap debate. Significant ethical concerns surround the industry. Predatory lending accusations, critics argue, lenders exploit financial desperation, target vulnerable groups, and use business models designed to trap people in debt. The rate cap debate. This is the central conflict. Advocates argue strict caps like the new 35% APR, $14 per $100 are crucial to protect consumers from exploitation. The industry argues these caps make lending to non-prime borrowers unprofitable, forcing legitimate lenders out and potentially pushing borrowers towards illegal loan sharks, or causing greater hardship due to lack of any credit access. It's a difficult balance between protection and access. Alternatives. It's important to know there are alternatives. Non-profit credit counseling services, like those available here in Waterloo region, offer budgeting help, debt management programs, and financial education. Community-based financial initiatives also aim to provide more affordable options, though awareness and timely access can be challenges. Slide 10, Conclusion and Outlook. In summary, the small loan industry provides rapid, accessible credit, but at a very high cost and with significant risks, particularly the potential for debt cycles. Recent regulations, especially the lower federal interest rate caps, are forcing major changes in the industry, likely leading to consolidation and shifts in product offerings. The impact on borrowers will be mixed: lower costs for some, but potentially reduced access for others who may no longer qualify under the stricter rules. This highlights the critical need for robust alternatives and strong community support systems, like those we have here in the Waterloo region. Moving forward, close monitoring of the market, including any rise in unregulated lending, will be essential to see if these regulations achieve the right balance between protecting consumers and ensuring those shut out of mainstream finance still have viable options. Q&A. Thank you. I'm now happy to answer any questions you might have.